All right, welcome everyone to the Solana Foundation Validator discussion, February 13th, 2025. A lot of things on the agenda today. So first of all, Validator Updates. We'll talk briefly about Accelerate NYC, which is a both developer and sort of product-focused conference in New York. It's happening in May. I hope to see a lot of you there. Some educational workshop ideas, and then the majority of the meetup, I think, will be talking about these SIMDs. So SIMD 123, 218, and 228 for a potential governance vote. Michael is going to kick it off, and then I think Tushar and others are here to talk through 228 specifically. So let's get into it. First of all, Validator Updates, Agave 2111 and FireDancer v305 2000-111 is recommended for Mainnet. If you have not upgraded, please do so, especially RPC operators. We are not yet at the cutoff for feature activations to fork off 2.0 versions, but it is approaching. So again, if you're an RPC operator, please update quickly before feature activations fork you off. SIMD 96 has been approved. Saw a lot of talk about that on X. So 96 is out there. Full priority fees are now going to validators. Very curious to see any data on that. Is there any preliminary feedback or thoughts from that activation? Looking in the comments here. None yet. All right. Well, yeah. Hope to see data soon. I'm sure Dan or someone will have data out there. Upcoming feature gates. So SIMD 133 get epoch stakes, which should be important for validator governance tooling, is currently 8th in the testnet queue. It's slated for 2.1 activation. So just need to get through the queue of activations on testnet and then on mainnet to get it activated. Probably in 2 to 3 months timeline, I'm guessing. There's about 6 or 7 feature activations in the mainnet queue. Once we get through those, we'll have to go through the ones in testnet. Typically, we do about 2 activations a week. So that's where I'm getting the 2 or 3 month timeline. Yep. And then SIMD 207 raised block limits to 50 million CUs. I know a lot of people have been interested in this one as well. It's 11th in the queue on testnet, so we should also have this for 2.1 in probably 3 or more month timeline there. Any questions on that for mainnet? Yeah, just some chatter about 96, but sounds like no comments. Moving ahead. Moving on to testnet. So we have more than 80% of stake on FireDancer on testnet. So thank you to all the testnet SFDP operators that switched over. Really, really important for testing. FireDancer is also on mainnet. We want to make sure we test that client well and sort of go through some feature activation cycles there as well. So this is not the long-term state of testnet, but for the next week or so, FireDancer will be the supermajority. If you haven't switched over yet, please do so. FireDancer 305, 2000, 111. And the plan is after we do some testing there on testnet, we will switch to Agave v2.2. So just a heads up, we'll be going back to either Agave or FireDancer within a week or so. Any questions on testnet? Yeah, some comments about FireDancer skip rates. I've talked to the FireDancer team. I know they're working on sort of a changes to optimize a little bit for lower end hardware. There's been a couple comments in Discord, but essentially there's a bit of a discrepancy between the hardware that's sort of best suited for Agave versus the hardware that might be better suited for FireDancer. And, you know, rightfully, most operators on testnet have hardware that's better suited for Agave, which is maybe not very high core count, but higher base clock CPUs. The thought is that FireDancer might work better on a base clock maybe not being as important, but number of cores being more important. So we'll see how that shakes out, but sort of TLDR, they're planning to make some improvements there. There's a question on whether or not SFTP will ever require operators to switch to Firedancer on mainnet. I don't anticipate we'll ever say that you have to run this version or that version on mainnet. We'll still increase min versions for both clients, but I don't think we'll ever have you must run this client. That's the whole point of having client diversity, is to have operators choose. Yep, just following the comments. Yeah, there's a question about the event in NYC is called Accelerate. There's not a lot online about it. Excuse me. But yeah, I'll
that event, the week of that event will be publicly announced next week, so you'll get some more details.
Great, yeah. Saul, who just spoke, he's running it, or not running it, but sort of putting together the event, helping to figure out programming and such. So if you have questions, I'll put his tweet up here in just a sec. Yeah, so Accelerate 2025 is happening between May 19th and should be 23rd. Here is Saul's post from before on it, so I'll put that in the chat. And Solomon is the one who is, again, putting together the agenda, so please reach out to him if you got thoughts on technical content that would be good for that event. Yeah, and sort of my plea to you all is I hope to see a lot of validators there. It would be great to have kind of validator-focused events, especially around technical conferences like this. So super excited to see a lot of you. Yep. Chat is really buzzing today. Hard to keep up. Yeah, any questions about Accelerate? All right. Educational workshop.
Sorry, Tim, real quick question. Ben said the developer focus event will be invite only. Is that the entire event, or is there a specific just developer side piece that's invite only?
Yeah, that's worth clarifying. So there's the first 2 days of the week are developer focused event, and then the Thursday, Friday of that week are a product focused event. The developer focused one, I think, is where validators would probably be more interested. And yeah, like Ben mentioned, that's an invite only thing. Validator operators are definitely the type of people that should be going to this event. So if you're interested, let me know, let Solomon know, let Ben know. We can make sure you're on the RSVP list.
Brilliant, thank you.
To be clear, we're not doing this, it's not formally invite only, but it is like, we're filtering for like technical people only. Like the dev event and the first 2 days of that week is going to be like, we don't want any like random token or VC shills showing up. And so we're going to screen for that, because we do want to protect this as like deeply technical, like if you can't use a command line, you shouldn't be here kind of thing. Because there will be a space for that later in the week where we're doing like a more general ecosystem and product launch flavored event. But we just really wanted to protect like deeply technical time for our community.
Awesome. Thanks, Dan. Yeah, details in chat there from Dan. All right, educational workshops. Quick note here, I don't know if Chris is on the call or not, but he mentioned an idea for a performance educational workshop. I think the idea was sort of optimizing your validator for performance, what metrics to look at, how to sort of hardware tune all the way up to like how to troubleshoot if your validator is not performing well. I think it'll be a great talk. So the plan is to do that on March 6th, the week before the next Solana Foundation call. Any thoughts or feedback on that? If Chris is here. Okay, well, that will be the plan. I'll talk about it in MB planning, but otherwise look forward to an announcement for that. Okay, and then for the rest of the call, I think the topic will mainly be governance. So we're going to talk about these 3 SIMDs. I'll put this in chat in just a sec, but I'm going to hand it over to, I think, Michael to kick it off.
Thanks, Tim. Yeah, hi, everyone. So we've got these 3 SIMDs that are pretty much ready for governance, and we're going to put them all up at the same time. So we're going to try to do 3 at a time, which is something new, obviously. And with the hope that, if we do 3 at a time, everyone can just kind of go and engage one time, review them and provide their comments during the discussion period, and then voting on them. So I'm going to talk about the content of the SIMDs shortly, just briefly on the kind of timeline for governance. The idea is to post the proposals on the forum on Monday at the epoch, I think it's 7:40. No, sorry, 7:44 maybe, something around there. Sorry, I don't have it in front of me right now. So we'll post the discussions up on US time Monday night, and then we'll have a 5 epoch discussion period, and then we'll begin the voting process. So that'll be in approximately 2 weeks, 1.5 weeks from now, and then 3 epochs, 1 epoch for stake weight capture, and then 3 epochs for voting. So the 3 SIMDs that we have are block rewards sharing, obviously a big topic. Most are probably familiar with the kind of concept of this SIMD, that it's been coming. And I'll talk about the content of that one a bit more. And then 218, which is intermediate vote credits, which Ashwin introduced on the governance call we had 2 weeks ago. And this basically just closes the loop on some of the vote modifications that some validators are using at the moment. And then 228, which is the market-based dynamic inflation proposal by Multicoin. And I think Tushar and Vishal are on the call, and they can comment on that. Yeah, any questions briefly on the process and timeline? And then I'll just talk about the content of 123, because Justin's not here. That's his proposal. And then I think Ashwin is here to talk about 218 after that. I see Zan is asking about the SIMDs not being accepted. That is correct. And that was a conversation some people had, is should they be merged in first? And the kind of feeling is that that isn't necessary to always be the case. I see Ben's answering it in the question, in the comments as well. But the SIMD process also speaks more to like the nitty-gritty of the technical implementation, and the government's vote is more of a signaling vote on the overall concept. Still with it, some level of technical implementation as well, but we think they can run in parallel. Okay, so just talking about 123 briefly, because obviously that's a big topic at the moment with 96 being activated. So 123 is a proposal, a SIMD that's, from the number you can tell it's a bit older, and essentially it proposes a in-protocol mechanism for sharing block rewards. And this is becoming more important because block rewards are becoming more and more significant. I was doing some calculations yesterday, and just for context, so people have an idea of the kind of magnitude. Right now, the total block revenue, taking the whole of January as an example, the whole block reward revenue accounts for about 25% of the whole inflation rewards. So that's not the commission validators receive, but before commission, the total inflation that was issued is about 4 times that of the total block rewards that validators received. So inflation is obviously still higher, but validators only take a percentage of that, which is why block rewards are a bigger revenue source. And block rewards are, you're now getting to a significant percentage of that as well. And so 123 proposes an in-protocol block rewards sharing mechanism. And essentially how it would work is validators can specify a commission rate and a collector account. So the block rewards wouldn't go into the identity account. If you specify it, it's optional, obviously. So you can say, okay, commission 10% and X or whatever is my collector account, and then your fees get sent to that account, and the commission is, and then that is sent to a collector account for every stake account as well. So as I said, this is Justin's proposal, so I can't speak perfectly to all the technical details, but that's the essence of how it would work, and it's, as I mentioned, optional. So you don't have to specify a commission or a collector account and just keep all the block rewards. But obviously the benefit is that it provides an in-protocol sharing mechanism, which is really important because LSTs only address some stakers, and there's legal questions around using LSTs. Another option is Jito tip router that's becoming available soon, but that has fees, and you're relying on a third party, and you still have the custody issue because you have the block rewards first. So that's the essence of 123. And then Ash, yeah, Brian, question?
Yeah, just had a quick question. Now that Max is on board, is it possible we're going to see some economic analysis on these older SIMDs or even the upcoming SIMDs? Because I'd definitely love to hear his thoughts on that.
Max, do you want to comment on that? I see he's just posted in the chat.
Yeah, I think this one is not a big economic proposal. I did do a lot of comments and stuff on 228, which we'll see later. And then we'll have some other proposals coming soon about vote credits and making those more incentive compatible so that vote mods are harder. So yeah, that's definitely something that we're thinking about. This particular issue, I think, is more of something is already going on outside of the protocol. And this is just introducing a way to do it in the protocol so that we can see it on chain, so that it simplifies accounting and we don't have to have the fees from something like a tip router from Jito, and it can protect the delegators from, you stake with somebody and they say they're going to pay you back and they don't actually do that. Well, this is a way to have it verifiable on chain.
And what's the best way to kind of see your analysis and feedback on these sorts of things?
I've been commenting on GitHub a lot. I haven't commented on GitHub on this one, but maybe that's a good shout out for me to kind of put my thoughts on this on the GitHub for this particular SIMD.
Great, thanks, Max.
Cool, thanks, Brian. Is Ashwin on the call?
He messaged me he's running late. I'm not sure if he made it yet.
Okay, then let's start with 2 to 8. Oh, sorry. Okay, no, Ashwin is here.
Hey, how's it going? Can you hear me?
Hey, Ashwin, can you introduce 218 intermediate vote credits? Kind of
Yeah,
just the
so-
content and how they work.
Yeah, so this is what we talked about, I think in the last overflow call. With this video is that there is this mod that's pretty popular, which self-votes for slots that are not necessary into the next vote. So sometimes voters will have a gap in their voting, and then after they resume voting, it's not necessary to stuff old slots in the vote. The consensus protocol only looks at the latest vote and ignores those anyway. For the process of credit economy, there's then more credits, which is kind of like a mismatch in incentives and more of a better alignment. So IBC proposes that the vote at the will also earn those credits that would even the playing field these incentives.
Cool, thanks, Ashwin. It was a little hard to understand all of that, but I think that everyone understand. But yeah, essentially the IBC fills that gap from the vote mods that are currently happening. So I think most people would be in favor of that. Seems.
Yeah, so
obviate the need for it doesn't mean that any sort of modifications or changes of the voting behavior would be made unnecessary, but the primary way in which the most common mod that is going around gets the most of its extra vote credit. So this would plug the largest reason to run mods, but it certainly doesn't eliminate like the ability for people to have differing voting strategies, which I think is fine. Especially if the voting strategies are improved consensus, where this one I think strictly does not seem to.
Yeah, maybe I can try and provide kind of like explain like on 5 version of what the mod is and why we're trying to get rid of it. So in Tower, when you vote on a child block, it automatically applies votes on the parent blocks, but that wasn't getting applied in the vote credits accounting. And so you could modify your client when you vote on a child block to also go ahead and vote on the parents, all the intermediate parent blocks. And so this was a mod that, ideally, as a general principle, we want people running the protocol so we know what they're running, and to reduce overhead for validators having to change things. So this would basically go in and apply that mod in protocol so that if you vote on a child, it will go in and apply all the intermediate credits that you could get by running the mod. So it obviates it eliminates completely the need for the mod.
Yeah, that's very well put. That's exactly it. There was a more concrete example in the SIMDs, which kind of shows the before and after credits in different situations.
Zan, go ahead. You're muted, I think.
Sorry, I clicked the wrong button. It's only because I just want to point out quickly that, not to toot my own horn, but it's only because of TVC I think that this proposal makes sense. If it wasn't for TVC, then a validator could simply vote once every 100 blocks and then get all the credits, for everything, that they could have voted on previously. But now, because you are penalized for a delay in voting, you shouldn't wait a long time and vote, because you'll get many fewer credits on the intermediate, slots that you could have voted on. I fully support this proposal. I just will point out really briefly that I think that it's not entirely correct to say that there's no value to those, the backfilling. It's only that our current code base doesn't really take advantage of the extra information that's supplied by those backfills. Any validator can predict how much stake could switch to a given fork based upon the lockouts that those other validators have achieved on the forks they voted on, and could use that information to decide what fork to choose based upon the possibility of fork switching by other validators. And then when a validator votes more heavily on a fork by backfilling, it is essentially committing itself harder to that fork, which is information that could inform other validators on what fork to choose. The current client does not utilize that information at all. And I'm not saying that I think that that's all that valuable and that we really should defer this SIMD just because we may want to utilize that aspect of consensus. I fully support the SIMD. I just wanted to point out that one minor issue for people to consider.
Yeah, I think that's a great point. I would just say that I don't think we want to be going in and making those types of changes to Tower at the moment as we consider what the future of Solana consensus looks like. It may not involve Tower. And so those are things that, we can go in there. It's often a little bit risky to change some of these consensus things, but it is a good point that you do have extra lockout information. But it currently is not part of the protocol, and it would require some changes to the default client. And I'm not sure that's something that is currently something that we want to focus on. We think there are better ways to improve consensus than that.
Yeah, it was actually really early on. The original fork choice didn't take into account. We had both stake and lockout, and then we switched to what it is now, where we only consider stake. But yeah, validators are free to build their own custom heuristics if they want to take lockout into. Keep that in mind. But yeah, if you run your own heuristic, then you risk the chance of leveraging from the rest of the cluster. So.
Okay, thanks everyone. And then moving on to 228. I think we've got Vishal and Tushar here. So just introduce that again.
Yeah. Hi guys. I can kick it off and then give it to Tushar. So we kind of briefly discussed it a couple of weeks back on this call. Just to summarize and keep it short. so that we can have more time for conversation. The real question here is, are we overpaying for security? Last year, somewhere in the second half, Solana real economic activity started surpassing Ethereum ecosystem. And at that point, there were questions like whether it's sustainable or not sustainable. But it does feel like over the last few months that Solana's real economic activity is actually sustainably higher than Ethereum's ecosystem activity. And also simultaneously, for more than a year, there has been concerns around the high inflation that Solana community has. So the question is, if a blockchain ecosystem has a higher real economic activity, potentially sustainably, should it pay higher emissions than the other blockchain? Like right now, so Ethereum is emitting less than 1%, about 70 to 80 bips a year. Whereas if you consider the dollars that are behind these networks, at current prices, they are around $75 and $90 billion. Like $75 billion is staking for Solana security, and Ethereum, that number is about $90 billion. But the difference in inflation, just the inflation part, the issuance piece, Ethereum is at 70 bips. Solana is at 400 bips, like 430 or something like that. That's massive. At current $120 billion FTV, we are talking about $5 to $6 billion of SOL emissions every year. And if the price is double, this number goes to $10 billion plus a year. Sure, that reduces by 15% every year, but these are like 11 figures we are talking about. And in reality, there are tax reasons and inefficiencies in the world, or different interpretations across the jurisdictions for what it means, ordinary income, capital gains, etc. And this creates, an unhealthy price discovery for the asset, and only source of capital that could even think about counteracting these negative implications is TradFi capital. But TradFi capital, even if they talk about bringing Solana ETF, like Bitcoin has an ETF, the fact that there's a massive opportunity cost of unstaking and buying the Solana ETF. I was talking to an issuer, and they're like, there's going to be extremely limited demand. All in all, also like the high staking yield, we think also generally prohibits the DeFi adoption on the chain. I understand there's a wide spectrum of views on this specific point, but to wrap everything up, a chain that has sustainably higher real economic value because of it is technically superior than Ethereum today. I think it's time to revisit our Solana emission schedule, which was, a fixed schedule for a time in 2020 and beyond, and revisit if we can, make it more market-based while balancing security with emissions. And to that effect, Max actually proposed a very elegant curve. What we think, we had a controller formula before when we were talking in the last call. We have now updated that to a simple static curve. Max can talk a lot about it. And if that's implemented and staking rate does not change, or is it around the same, it would bring Solana emissions in line with Ethereum. And I think this is just a sign of maturity for the ecosystem, and we should take this seriously. Tushar, if you want to add anything on top of that.
Yeah. Look, I'll summarize it because that was a lot. Having higher inflation than needed is bad. And the reason that it's bad is a few things. One, it increases the hurdle rate for using SOL and DeFi. We want to use SOL and DeFi. We want DeFi to be successful. That is good for the network. Two, it increases selling pressure on the asset because some people sell their staking rewards. Whether it's for tax reasons or other reasons, people do sell their staking rewards. And then three, even if people don't sell their staking rewards and you see if you assume the valuation of Solana is constant over some period of time, due to inflation, you would see a decrease in the per token price, which creates a bad looking chart and bad sentiment, and capital markets don't like that. And then fourth, and quite possibly one of the more important reasons, is what Vishal mentioned. Having a very high inflation rate will reduce demand for an eventual SOL ETF. The first SOL ETF will not be staking at SOL. In some theoretical version in the future, I could see a staked SOL ETF, but that is much further out. There's a lot of considerations before that happens. I do think we see a unstaked SOL ETF soon, but if we want there to be demand for it, you can't have an enormous opportunity cost to owning the ETF. So that's my summary of motivations. I'll turn it over to Max to talk a little bit about the new curve.
Yeah, for one thing I'll say is like on the staking versus non-staking ETF, I think the legal situation of the staking ETFs is still unknown at this point. And so if you have an unstaked ETF that's, losing 6%, 4% a year to inflation relative to what you could have owning the asset, that's not something that's going to create a lot of demand. So just to highlight that point. For me, this proposal, the most convincing reason why higher inflation than is needed is a bad thing is because of this, what I call leaky bucket of inflation, which is when you take money from SOL holders and you give it to SOL validators, inevitably some of that transfer is lost, and that's lost through unfavorable tax treatment or through people with market power like a Coinbase being able to take an unhealthily high rake on that. And so those are kind of the reasons for me that I support the proposal. And I'll say a little bit more about the new curve, which is much simpler than the old controller, which was kind of a 1559 style controller. The new curve is static. It's a lot easier to reason about. It reduces the total issuance based on a factor of 1 minus the square root of the percentage of the network staked. This also makes it a little bit easier to implement. I took a look in the code, and it's not as big of a change as it would have been to do this controller. So that's basically my perspective. Is this is really about the leaky bucket of issuance, and I would say, depending on how you value that, for ordinary income versus for capital gains, for U.S. individuals, that's a 17% difference at the highest tax bracket, and for U.S. corporations, it's taxed at the same rate, but you have a difference in tax treatment in terms of what you can offset. So you can't offset capital losses with ordinary income. So these are both reasons that the U.S. government or other governments around the world are basically poking a hole in the bucket of inflation. And it's actually, if you look at it, we have something like 4 to 5 billion a year of issuance, and if 10% is leaking out, that's $400 to $500 million a year of net heat loss for the system that we don't need to do.
So can I comment?
Yeah, I saw you raise your hand.
Yeah, Max's comment at the end there is actually exactly what I wanted to talk about. Is when we say, okay, well, we're leaking issuance to like sell pressure to pay for taxes, like we can calculate that, right? So right now we've got, let's say, rounded up to 600 million total token supply, and at 4.5% inflation without accounting for compounding. Okay, I don't have that number in front of me, but if we say, okay, whatever that inflation is, I think it's like 100 million or less, like 50 million or something. But then we have to say, okay, what percentage of stakers care and consider that to be taxable income? Let's say it's 50%, it's probably much less, but let's say 50% of all stakers say, okay, I'm receiving staking rewards, I need to pay tax on it right now using the staking rewards. So 50% are going to unstake their emissions. And then let's say the average tax rate is also 50%. And the number I get to is in the same ballpark as what Max said. Actually, it's higher. It's like $1 billion a year, because obviously it's a very high assumption. So let's say there's $1 billion a year based on the current SOL price in sell pressure to cover tax liability. Just for context, that's less than half of the 24-hour trading volume of the Solana token on CoinGecko. So I don't know what that means, because obviously trading volume goes both ways. But it doesn't seem that significant to me in terms of like the price,
So let me say, I think, first of all, I think the number to compare it to is not the trading volume, because that's really a function of volatility and a bunch of other factors, and demand for liquidity, not necessarily a thing about the value of the asset. I think the proper thing to compare it to is to compare it to the fees on the network. And even on our largest day, we had like 30 million in fees for the network. So like a 500 million, that's like, very massive compared, it's on the same order of magnitude as our annual fees. So I think that's like really something that does matter. I would also say the reason I got to my number is because I looked at the relative difference between the tax treatment of capital gains and ordinary income, which is relevant in the US. And my assumption there being, if this doesn't come in through the ordinary income pathway, it's going to come in through appreciation of the price of the asset. and that will be treated as ordinary capital gains. So that's why my number is smaller than yours. And it's basically, I think, coming out to around 500 mil a year, which is a relevant number when you compare it to our fees.
Yeah, my first number was like 220 million based on a 10% tax rate, which is obviously very low. So, but yeah, I think realistically, we're looking at between 200 million and $1 billion in kind of sell pressure per year.
Yeah, I agree with what Max said there. The one other tax consideration is cap gains can be deferred until you realize them versus ordinary income is realized immediately. So if you defer cap gains, that means that there isn't any sell pressure this year, and you can defer them, as long as you're willing to hold the asset. So that's a meaningful difference. It's not just a 17% spread; it's also a time value of money spread. And I agree that comparing trading volume is not particularly helpful. Trading volume is extraordinarily volatile. You can say this as someone who has traded a very significant amount of SOL over my life. The trading volume and liquidity is not something that you can just expect to stay constant. It's going to vary. So the right comparison is to the actual revenue of the network. So the REV. I see we have Tim next.
Yeah, Max, I was hoping you can give a little more intuition on the controller. One thing I'm worried about is the other problem, which is the economy might become too deflationary in some circumstances. So just like at the extremes, what does the controller look like?
Yeah, I guess I would say, deflationary, people really worry about deflationary in the context of something like the US economy or, the US dollar. And I think the classical argument is that if the asset is deflationary, then it will prevent circulation and it will inhibit growth. And I'm just not sure that type of argument tracks over from, the reasons that they do it for the US economy versus what we should be doing for Solana. So I guess I'm not too worried about deflationary issuance. This proposal will not allow, at any point there would be no possibility under this proposal of being deflationary. You still have positive issuance no matter what the stake is, unless it's, I guess, 100% of the network staked, in which case it would be zero, but that's obviously not going to happen. So yeah, I'm not too worried about the deflation thing. I think right now we're kind of way in the camp of too much issuance, and this would bring us down to more of the level of where ETH is at today. And so I'm not too worried about it.
I would also add one thing, that the way this curve is constructed, and if the staking rate continues to trend down, this also kind of puts a gentle upward pressure on issuance, which also kind of takes care of the balancing the security of the network, just in case if the staking really starts going down fast.
Tim, does that address your question?
Yeah, I think so.
Cool.
Chris, thank you.
Yeah, hi.
Chainflow next.
Yeah, thanks. Generally, I support the proposal because I think, as some people have reminded us, that the inflation was a means to bootstrap the network, like Zan says here. And I think we're in a fortunate position where the need to bootstrap the network on, with inflationary rewards is continuing to diminish, which is a really good sign for a healthy network. I think Solana is really, in my experience, the first network to get there. So I think, that's really good news. So I think also that this is a good time to start experimenting with that rate. The question to me really comes up as to what sufficient security is, and how do we define sufficient security, and what that target level of stake is. Reading through the proposals in their different forms, 67% seems like probably the high end of the range to target. So I could see 50% as being a reasonable place to start. But generally, I think this is a good step in the right direction if we see this as an iterative process and agree as a group to continue to look at it maybe quarterly and adjust as necessary. But then the question to me comes up to, how do we measure this, whether it's being successful or not? I guess one obvious dangerous measurement is, okay, the network hasn't been successfully attacked, but that's probably not the right way to measure. There are probably better ways to measure that. But ultimately, I think we'd want to talk about, like, how do we measure whether this is having its intended effect or not, and agree to, hold subsequent votes as necessary to adjust the curve if we need to.
Yeah, I think this is a great point. And I guess I would say, in terms of the security analysis, I did some math in the proposal, which you guys can check out, which says basically, we know that at least the rate of validator rewards today, under the new curve, we would achieve those same rate of validator rewards at 30%. So right now we have, 67% demand, and we would see that same level of availability at a 33 or at like a 30% stake rate. So we should expect, I think, to your point, like somewhere around 40 to 45 to 50% staked. And I think 50% is probably that sweet spot that we could agree on is, maybe a good spot for the network to be on. In the ETH issuance discussions, they had agreed on 40%, but I think anywhere in that is reasonable to be. I have a post coming out soon. I think it's coming out on the Anza blog, but it's basically issuance from first principles. And the idea is, what is issuance good for? Well, it's good for providing network security, and it's also good for ensuring that people are behaving in the protocol. So to your point of like, what are the metrics that we should look at? Well, the first is, do apps feel comfortable building on Solana based on the level of security we have? If we're in a position where we feel like we don't have enough security, that a BlackRock doesn't want to issue assets on the chain because they've raised concerns about the security, that's clearly a red flag that we need more stake. And on the other hand, if we see stuff like timely vote credits, because the incentives are going to go down, if we start to see higher missed slot rate or less adherence to the protocol, I think that's also something that is a sign that something is going wrong and should be looked at again. But I don't expect to see any of those things. So I think if we do this change and then we don't see anybody saying, oh no, Solana's not secure enough anymore, which I don't think we will see, and we don't see any large change in the kind of rate of missed slots or any other adherence metrics on the protocol, then I think we can say like, yeah, we were definitely overpaying before. Here we are. It's at a pretty good spot.
Yeah, I appreciate that. I think the only thing I would add, and to wrap up, my comments here, are that I've been trying. I think I'd be more comfortable thinking about it if like we could determine what we feel like as a group is the right level of security. I don't have a good way to do that, so like the suggestion only goes so far, because I don't know. I don't talk to them, but larger traditional institutions, I don't know if they have the in-house expertise to really make that kind of call. Maybe they do. Maybe that's good news, and that could be helpful for us. But ultimately, and I guess what I'll be thinking about is how can we think about that from the ground up, and really think about, from an attack vector, how much stake do we think someone could reasonably capture if they really wanted to, and do harm to the network. But I appreciate the perspective you're coming from too. Don't have a better solution to offer at the time. So I think moving forward incrementally is a good move.
Yeah, I appreciate that. I would just add a couple of things. I put this in the chat, but for context, Ethereum's staking participation rate is like 27.5%. So there's plenty of room. I talked to Tolly about this before we put the proposal out. He mentioned that we have seen Solana staking participation as low as 20% and as high as 90%. And the network functions well under both extremes. So he didn't see a reason why it would be dangerous if staking participation did decrease under this proposal, which I tend to agree with. And then the last point I'll make is recently I saw a stat that said, the total dollar value of SOL staked exceeds the total dollar value of ETH staked right now, which is because of the much higher staking participation rate. So another interesting stat to consider that makes me lean towards we are vastly overpaying for security.
Yeah, just to put a cap on that, I don't think anybody in here would say that ETH is, undersecured. So I think we have some room to come down on staking rate if that's necessary in order to eliminate some inefficiencies in terms of this emissions.
Yeah, if I can just add one final comment, and then don't want to rush anyone, but I just want to wrap up the kind of substance conversation and just touch back on process after that. But just a final comment on 228. One other concern that I had was the kind of the speed of the change, and I don't know if everyone is kind of aware of that, and I want to just make sure with Max here that I'm understanding it correctly. If implemented today in this epoch, next epoch's inflation rate would be like 1.5% or something like that, right? Like we would see an immediate drop. And my concern with that would be, my concern with that would just be that, stakers could feel kind of caught out by not seeing more of a gradual decline and a chance to kind of pick that up and unstake.
Yeah, sorry. Yeah, so I think it's a good point, and we have a provision in there that would allow for a kind of phase in. So if you just change one thing in the protocol to be kind of epoch number over number of epochs for the rollout, we started with 10, and I think we're open to feedback about what people think that number should be. I definitely think we don't want the whiplash. So yeah, I think right now we're kind of thinking it would be a 10 epoch rollout, and if people think that's not long enough, then we're happy to discuss any concerns.
Yeah, I hadn't seen that last change. 10 epochs is a good number.
I would add, I mean, to me, this really feels like an important SIMD to get delegators' feedback on as well, because this ultimately impacts them very, very directly. So, Michael, I think to your point, we assume that maybe they're comfortable using DeFi, but maybe they're not. And if they know they can't stake, what would that do to the token price? Maybe they sell and, buy on another network where they can stake because that's all they're comfortable doing. I'm not saying they will, but this does seem like a place where we should really, really try and engage the delegators to provide at least some indicator of their comfort level with this.
Yeah, I would definitely strongly recommend that validators reach out to their stakers, see how they feel about the change. I guess the risk there, if you don't vote where your stakers would like you to vote, there's a possibility to lose stakes. I think making sure your stakers are heard probably net positive for your own operation.
Yeah, if I can just add to that, so the nuance of the wording there, because Chris said can't stake, and I just want to be clear that there's never going to be a situation where you can't stake. It's just that obviously the rewards are less, and there's still GTO, which is currently 4%. So even if inflation rewards are like 2.5%, you're still getting GTO on top of that, and then potentially block rewards in the future.
Yeah. If I said that, no, that was a mistake. I don't mean to say can't. I think I meant more like, yeah, if it drops to a level that they feel is way too low and they're not comfortable with DeFi, then what are they going to do?
If I can chime in here, I have two comments. One, on the capital market side, I don't think yield from inflation is a return to stakers. It's a redistribution of ownership a little bit from non-stakers to stakers. But to give you just a reason by extremity, if you had a network with a 10,000% inflation rate, like that wouldn't mean that like you should go and buy that token to stake it, right? Like that's not a reasonable investment mindset of like, oh, the staking rate's 10,000%, I should be long this thing. So I don't think any sophisticated capital allocators and even mid-curve capital allocators are thinking about staking yield equals I should buy the token, low staking yield I should sell the token. And then the second thing, Zan said this in the chat, but I just wanted to flag it verbally because I agree with this a lot, is that non-delegated SOL doesn't have a validator to represent their interests. So of course, validators reaching out to your stakers or your delegators is a good idea. Like you should definitely do that. But Zan makes a good point of delegators are the ones benefiting disproportionately from too high inflation. So I do think that we should consider the other SOL stakeholders as well.
Yeah, that's a really good point. Can I gently redirect us away from discussing the substance and just touch back on the process if no one has any more comments on the substance there. Obviously, there'll be, and with process, I just want to reiterate that these will be posted at the end, I was checking earlier, at the end of Epoch 243, which should be Monday night in the US. And then we'll have basically a 5 epoch discussion period, 249, which is about 10 days. And all of these questions can be delved into a bit more detail on the forum. So Vishal and Tushar will obviously post their proposal on the governance forum, forum.solana.org, I think. And the same for 123 and for 218 for SIMDs. So please obviously go and read the actual proposal text and post your comments on there. And then we'll do this as with previous governance votes. We'll do a token distribution, and validators will use their identity keys to cast their votes. Any final questions of the process? Or I think if someone did still have a question on the substance of that last proposal, someone
Just
had
to
their hand up.
confirm- Just to confirm on the process, so this is starting like the official discussion period once it goes up to the forum.
Yeah, so that'll be, let's say the start of Epoch 244.
Okay.
Roughly. Like,
Thanks.
the discussion period is more fungible. It's the the end of the voting period that has to be like a very specific time.
Right, yeah, I just
So-
wanted to make sure
yeah.
we weren't considering this as the discussion period and then we jump
No.
right into the vote. Yeah,
Yeah, the 249 is projected where we would capture the stake rates and do the verification. So, which is obviously also more time for discussion. And then epochs, so not 249, 749. And then 750 to epoch 752 would be the voting epochs. So yeah, that's almost 20 epochs from now. Okay, all good.
Cool. I think that wraps it up then. Thank you, Michael. Thank you all the presenters. And gentle reminder, we've got the community-led validator call in 2 weeks, a educational workshop the week after that, and then this call again, second Thursday of the month in March. So lots going on. Thanks, everybody.
Thanks all.